Welcome to episode 8 of This Week in the Metaverse. Yon is still on his well-deserved vacation, so I'm happy to be joined this week by Aaron Bush, who's the co-founder of Naavik and previously an investor. Great to have you join, Aaron.
Yeah, thanks to be here. Jan has done a lot of great podcasting work with us at Naavik, so it's only fair to give back some time, and I'm very excited to be with you today, Matthew.
Awesome. So as you all know, each week we like to pick 3 items and kind of break them down, items where not only they're important to the development of the metaverse, but where we think we have unique insights and expertise that we can share to really add a lot of context and value to it. So this week, the 3 topics we're going to talk about is, first off, an article that Yon was actually quoted in. Does the metaverse need blockchain? From Cointelegraph, which I think is a really interesting conversation, and we could probably talk for an hour plus about that, but we're going to cram it in. Second is Meta slashing its hiring plans and girding for fierce competition. That's from Reuters. That's quite interesting, and it builds off the conversations we've had the last few weeks. And then lastly, we always like to talk about startups as well. Soba.xyz raised a $13.5 million seed round. That's a big seed round if you don't follow seed rounds a lot. And launched an alpha of its no-code UGC platform. So we're going to also talk about what that means as well. But before we dive in, we just have a short announcement to share with you. This podcast is brought to you by Roundhill Investments, the advisor to the Roundhill Ball Metaverse ETF. The Roundhill Ball Metaverse ETF, which trades on the New York Stock Exchange under the ticker symbol METV, is the largest dedicated metaverse fund in the United States. The ETF tracks an index developed by Ball Metaverse Research Partners, a metaverse-focused indexing and research company headed by industry expert Matthew Ball. For a prospectus and more information, please visit roundhillinvestments.com/ETF/METV. Read carefully. Investing involves risk, including possible loss of principal. Investors should consider the investment objectives, risks, charges, and expenses carefully before investing. Distributor Foreside Fund Services, LLC. Great. So jumping right into our first topic from Cointelegraph. So they're looking at the landscape of the metaverse and how blockchain and Web3, as that's known, fits into the metaverse conversation. And the headline really sums up the conversation nicely. Does the metaverse need blockchain to ensure widespread adoption? They interview a lot of academics and experts, including Yon, as I mentioned. And the conclusion they largely come to is no, the blockchain doesn't need, the metaverse doesn't need blockchain to make it happen, at all, but to make it happen in a democratic, equitable way, blockchain might be the best way to do that. So Aaron, curious what your thoughts are there. We can kind of, spitball off of that.
Yeah, well, I think in terms of the big question, does the metaverse need blockchain? I kind of think it's a silly question, to be honest with you. I think we pretty obviously don't need blockchain technology to continue iterating on what the internet is going to be. Every day the internet enables awesome creations and communities and commerce and immersion without that specific payments or finance railing being involved. That said, it's also obvious that no matter how you answer that question, blockchains are going to be part of an evolving metaverse because they already are. They've been increasingly relevant for the past decade. And despite the current, ferocious bear market, there still is so much talent, product momentum, capital, and willpower in the space that's not going away. So I do think that blockchains will be a notable force simply because it's a great way to enforce digital ownership and have systems for capturing and moving value that are native to the internet. And we're still just scratching the surface on what that will look like. In the future, any talk of blockchains will mostly be abstracted away. Wallets, which, are the key UX point for people, will become super smooth to use and get onboarded into. And any fee friction will, in most cases, I think, become negligible or even covered by merchants and platforms like it often is today in the real world with credit cards. So, I think it is going to be important, no matter what your answer is to that question of whether it's needed or not. It's here, and it's probably going to stay relevant in some way. But so, I have thoughts on whether it'll lead to a more democratic and equitable society, but I'll let you comment on that first and see if you agree with me or not.
No, I totally agree. I mean, I think a lot of people forget that PayPal was one of the biggest enablers of e-commerce. Having a digital wallet that you could use across different platforms and sync up money into was a huge thing because we're in the US where even a lot of people today have, bank accounts, digital access, and credit cards, but even so, not everyone does. And as you go outside the US and you go to parts of Europe and other emerging markets, there's a lot larger unbanked population. And so we need these digital services to act as conduits to get people to interact in digital platforms, and whether that's e-commerce or eventually the metaverse. And so whatever, as you said it nicely, the financial rails that get us there, whether that's blockchain or not, we're going to need that. And so I think it will play a role for exactly why you laid out. It's that it's giving us what seems to be an elegant solution to lots of different things, whether it's interoperability of cosmetic assets or the financial aspect of it. Is it the only solution? Absolutely not. And I think there will be others that come about. I'm curious to see what this whole Metaverse Open Standards group does in terms of that aspect, not just in terms of the cosmetics, but in terms of the financial side of it. Because if they don't build that, it probably will come from blockchain, because no one else is really building it specifically for this. And I don't think it's something you just want to leave up to the whims of Meta and Apple and Google to redo, because you're just going to end up with the same thing that you have right now.
Mm-hmm. Yeah, I think that's well said. And so, yeah, it's not really a question, I think, of if blockchain will be relevant to the metaverse, but really a question of how relevant it's going to be. And I think that still is very much TBD. But thoughts on whether it will lead to a more democratic and equitable society, that's also interesting. And I'm not swayed that it will. So in theory, having communities and products and networks be owned by anyone on the internet, removing barriers to entry, could lend itself to more decentralization and opportunity than, let's say companies that get founded in private markets with only a handful of participants. I think that's absolutely true, and that's noteworthy and commendable and super interesting, unless regulation gets in the way, but that's a completely different topic. But I'm starting to think that it actually falls apart in practice, because there's usually no mechanics in place to stop the Pareto principle, the 80-20 rule, from coming true. So for example, at Naavik, we spend a lot of time studying and advising blockchain games, and pretty much without fail, all of them are very concentrated in ownership, even though they all have, open token sales, they're tradable online, etc. Nobody would be able to own them if they were behind some company. So there is that. But, even though they are out there and the assets are ownable, they still are very concentrated. And that concentration lends itself to plutocracy, to the largest asset holders, whether it's digital land or governance tokens, whatever version it comes, those largest asset holders have outsized sway. And so I was even looking at a game today where voting can be ruled entirely by the top 10 holders, even though there are many, many thousands of other holders, just because the top holders own so much, whether it's an individual or a guild or something like that. Like it, that being real is, I don't want to say scary, but it's not even close to being idealistic. And this is something that Vitalik of Ethereum fame wrote a year ago or so in an essay called The Problems of Coin Voting Governance. Inherently, there are a lot of problems with that. And I was working with one of my teammates today, actually, Anthony Pecorella, on a new research report, and, related about other ways to make blockchain games, assets on blockchains, and the governance around it more equitable. And one simple example Anthony mentioned was the idea of quadratic voting. And without making this conversation too technical, basically that just gives voting power as the square root of tokens held. So it still weighs the top owners quite heavily, but it also gives the long tail of the smaller holders much more influence too. It doesn't solve the wealth inequality at all, which I think exists pretty much across all anywhere that wealth is stored on a blockchain. But at least it gets a little bit to the plutocracy risk. But the issue that I see, and then I'd be really curious to hear your thoughts on this too, Matthew, is that I don't actually see any teams really implementing these creative solutions yet. And, granted, I'm not paying attention to everything, and I'm sure there's people experimenting somewhere, but, that's a big part of why I'm not convinced that just blockchains as a technology will drive some great social renaissance and, equity, like a more democratic internet. Like, we'll see how best practices evolve over the years, but at least what we've seen so far, actually the opposite is coming true. So if we want that to be true, we need like new types of mechanics and, principles and practices in place to get us there.
I won't give away too much of the goose because the episode's coming out on Tuesday with Tim O'Reilly, who's famous for kind of, making the term open source and Web 2.0 very popular. And so, he shared a lot of thoughts with us about the state of Web 3. And we really don't have Web 3. To your point, we have basically, it's not even Web 2.5. I joked that it's Web A16Z at this point, that what we really have is just, if you looked at the internet in the 80s and the 90s, we built the protocols, and then we had some big hype cycle, and then it crashed, and then capital flowed in afterwards to get us through the crash. We haven't even built 10% of the protocol scale that we built in the internet before the bubble happened in crypto and Metaverse and Web3 and everything. And so where we're at today is just so early, and there's so much capital going in that it's inevitably going to lead it to being controlled by a small set of VCs that are investing the capital. And so it's exactly what you're saying. So we're actually going to end up with not what we want. Now, this goes to the other conversation we had recently with Professor Udi Shapiro from the Weizmann Institute in Israel, where, we need these kind of community-based crypto blockchains to really drive this egalitarian view. The question is, investors have to invest in this to make it happen. And unless the governments do this themselves, no one's going to do that because people want to make money. And so it's, that's always the dilemma we run into is the profit motive and investors looking for returns versus this egalitarian vision that people have. And so, I don't think anyone solved how we bridge those two views. I don't think anyone necessarily is fully all in on, building this purely community driven blockchain, but I think the technology exists. And I think we do need governments to get involved to help us get to that point if they want to avoid what happened with the current iteration of the internet and the control of very small number of large platforms.
Maybe. I don't know if I 100% agree with all of that. I just think that we need to separate where technological advancements are happening related to finance away from the idea of revolutionizing economics in some way. Like, those are two completely different topics. You don't revolutionize the laws of economics and money just by having a different, underlying architecture behind it. There are obviously externalities that occur, and it's interesting and important to, think through what the implications of, creating some new monetary policy or new payment rails look like. But I think people get a little carried away sometimes when it comes to extrapolating what this is ultimately going to mean for the world.
Yeah, absolutely. And, we've all seen it happen many times over. All right, so I'm going to move on to our second topic for today. So as I mentioned, it's kind of a dovetail from our conversation we had last week with Mario Stefanidis from Roundhill, really talking about Meta Platforms, the wrapper formerly known as Facebook. So Reuters is reporting that Meta is cutting its hiring targets for 2022 by at least 30%. And they're also not replacing staff who depart the company. What the article says is they're now only looking to hire 6,000 to 7,000 engineers, down from 10,000. They're also leaving positions unfilled and turning up the heat on performance management to weed out staffers unable to meet more aggressive goals. It doesn't look like there's actually layoffs happening just yet, but obviously the slowing in hiring is coming on the backdrop of a big round of tech sector job cuts. When I ran the numbers yesterday, TrueUp has a nice dashboard that shows this. Over 67,000 tech sector job cuts have been announced year to date, which is it's a lot. I mean, you look at the monthly payroll numbers. That's a big moving target to affect the numbers. And so, how do you frame what's going on there in terms of their hiring at Meta in the context of the broader tech landscape, given what's going on, and then specific for them, what does it mean for them and their metaverse strategy?
Right. So let's break that into parts. So as for the tech industry, I think two general things are now true. One, capital is more expensive. If a team wants to raise money, whether via debt or equity, or even just use existing cash for things today, it costs more and has worse terms associated with it than it did 6 to 12 months ago. And that's important for a lot of tech companies out there that, are fueled by raising money to cover, losses or even to pay for employees through issuing stock. It all has pretty big implications. And then second, the recessionary factors at play are, likely real. Consumer and enterprise spending are probably slowing in a lot of circles, which affects growth expectations, which affects budgeting and ultimately affects how assets of these companies are priced. So that's affecting everyone, Meta included. But as for, the second part, as for Meta specifically, I think there are, there are a couple factors worth highlighting. Let's call it like two external forces and one self-inflicted. The first external force is TikTok. Competition is higher than ever for Meta. It's having a real impact on engagement. And Meta is now investing aggressively to make its products more TikTok-like in places, which means higher expenses. They can't just acquire like they used to in the past, so they have to invest even more heavily to try to fend off competition. And then, the second external factor is Apple's privacy changes, which are very clearly having an impact on how well the social platforms can help advertisers target new customers. And when user acquisition prices rise, demand falls, which then slows growth. And again, Meta is having to reinvest and put more expenses into building more complex advertising functionality. So with those two factors alone, we're seeing real revenue pressures at Meta that managing is at least trying to somewhat solve for via higher spending. And so when you have the top line pressures going down and then revenue expenses going up, that's not a great combination to have. And so it's not a surprise to kind of see the third factor at play, which is, Meta's heightened focus on metaverse technologies, which comes with high expenses but little revenue right now, and therefore like that being a source to cut back on, at least in the interim, while all of these other pressures exist. And so in my mind, it makes sense from a broader resource management perspective that Meta needs to rethink things and refocus around the specific areas that matter most. And with Meta and their metaverse initiatives, what I think this does on one hand is slow down investment into new technologies and platforms, which I'd argue is a negative. But on the other hand, it forces Meta to focus better than it's done in the past. And, one of my top criticism of Meta's metaverse and VR strategies, however you want to classify all of that, has been that lack of focus, where you see the company try to tackle extreme vertical integration to kind of force hardware onto the market and try to kickstart early adoption, and horizontal cross-industry technologies to expand beyond Meta's hardware, just various software platforms and such. And they're doing that at the same time, basically trying to have their cake and eat it too, and you just can't do that. So I'm hoping that this reset will actually be healthy for forcing the company to really decide where it doesn't want to direct resources as much as the places where it does. And that might come with restructurings and staff changes that do affect employees in real ways. If Meta didn't have so much cash, or just, wasn't such a big company with so much, access to capital and cash on hand, maybe they would be resorting more to layoffs than just, having a hiring freeze, as opposed to other companies. But I do think this probably is the right path. In some ways, they've already been moving down this path, creating their own, VR operating systems in the past, and dropping plans for building in-house design chips. But I think there probably is more to deprioritize and double down on. But hopefully this pressure will create some focus for their metaverse initiatives. Do you agree?
I think you hit it on. I was going to say, I think you hit it on the head. I've always been an advocate that since the get-go, if Zuckerberg was serious about being all in on the metaverse, this should not have been part of Facebook. This should have been a standalone entity from the get-go. Just I'm no Elon Musk fan at all, but at least he has the wherewithal. Okay, I want to be in space. That's a separate company from Tesla. Because, if you're an investor, you know what you're buying with Facebook. You have no clue what you're buying now and how much money they're going to pour into Meta and Metaverse. They laid out $10 billion a year, but are they going to cut that? And how do you value a company when you have no clue what they're doing and what their expenses are going to look like and how much they're going to invest in something that, as the company literally said, has no return for 10 to 15 years. They said this is at least a 10 to 15 year, investment cycle before they harvest returns. And so that's just a crazy long time for, let alone public company, any company. And so, I agree with you 100%. Where are they going to right size? Where are they going to rationalize? And where are they going to focus where they think they have an advantage? I'm still skeptical that VR is the right, launch point for the metaverse. If you look at any company that's considered a leader, it's either the game engine software companies, which you can't really catch up to at this point, and it's gaming companies. And I think, they don't have either of that. I don't know where they're going to get the talent for people that have experience in developing experiences in real-time 3D. And so, it would be, if Microsoft can buy Activision Blizzard, we'll see what the Justice Department says. They should also look at acquiring a gaming company as well, I think, just to get experience in developing these experiences. That's saying the word experience too many times, but I think it makes a lot of sense for them to do that, and to, okay, now we have resources in place. Now we can actually build what this wants to look like, because gating something behind a VR headset is never going to reach mass adoption.
Yeah, I agree, at least for the foreseeable future. And there's a big question of just like, how big really is the VR opportunity? Is it is it PlayStation level scale, or is it smartphone level scale? And at least so far, like, it's having a really hard time even getting to like PlayStation level scale. It's still like a tenth of the way there or so. And for a company of Meta's size, it's not exciting at all. And I think they recognize that. I think they, being able to reinvest their profits from other parts of the business, like, that is an advantage that helps them push the future forward faster than we probably would see otherwise. And I appreciate that as a consumer and fan of technology. But yeah, it's tough. Granted, they are investing, in other things too, experiences. They're trying, what was it? They bought, Unit 2 Games, which is sort of like a, I don't want to call it a Roblox ripoff, but it's just like, that Meta would want to buy Roblox if they were allowed to, and maybe even if Roblox wanted them to. They just can't for regulatory reasons. And so they have to do other moves like this, which, it slows them down, takes more investment, and probably just makes it harder to redirect capital in big bursts in ways that would actually be effective for creating shareholder value. So they have to resort to building things from scratch versus buying things that they already know work, which is just more capital intensive. So yeah, as like putting my investor hat on, it's less exciting. And I think most people recognize that. If you buy Meta stock right now, it's probably, it's probably not even pricing in, any upside from any of the metaverse initiatives. For better or worse, right or wrong, you can decide. But I don't know. Still, as a consumer, I'm curious to see where it all goes. There's only good things and innovation to be built, so I'm still rooting them on.
Yeah, I'll leave this as the last comment, and then we'll move on to the next topic. But you mentioned like PlayStation scale. They're not even at like AirPod scale. Like, they're not even like touching the surface of like little tiny earbuds we put in our ears. And so, obviously there's a branding aspect with Apple that's helped that. But, I think there's also just a question of, and I've said this before, I don't think a lot of people want to be walking around like doing the Thriller dance with VR headsets and controllers. They want to be social. And so I think that ties nicely into the next topic we're going to talk about, which, again, we like to go to startups when we can, and I saw this raise and I thought it was exciting. So Soba is raising a seed, or has raised a seed round and launched an alpha of their UGC gaming platform. It sounds both exciting and very ambitious what they're doing. So from the CEO and co-founder, I'm going to butcher his name, Juha Pananen, on Twitter, I believe that's Finnish. Soba has raised a $13.5 million seed round and launched an alpha of its platform. Their investors, it's a good bench. It's Lightspeed, FTX Ventures, Cherry Ventures, Point Nine Capital. So it's a good bench of investors. As the CEO says, creation tools are currently limited to PC. They're extremely complex, and many UGC platforms enrich. The UGC that's out there, like Roblox, makes the platform rich, and the creators get very little left over. And so they're trying to make a no-code UGC tool that can be used on any platform, including mobile, and is purpose-built for Web3 as well. That might just be a throwaway to get more funding. We'll see. And then, so it does sound quite interesting, though, because one thing I've always said is whoever can figure out real-time 3D development, UGC, with low-code, no-code, that's the holy grail of what we're after. And so I'm just curious how you think about that and empowering creators.
Yeah, well, I don't have a bunch of deep thoughts about Soba in particular, but maybe a couple positive impressions, and then, we can talk about UGC more generally. So, it is a pretty huge seed round, right? what, 13.5 million. But it is one of those ideas that is big, and you can't really give it a half attempt. And like a super competitive market, like you do need to commit pretty fully. And so, that's a big seed round. They'll probably raise a lot more. Probably not too far into the future. So I like the commitment to build something big, and also just anytime anyone's putting in the work to democratize and reward more creation, I think that should be celebrated. It's great to see the no code support. We don't really know the details about how creator payouts will work, or if they'll even be able to bypass app store fees in some ways, which is often the main issue. But very curious to see how that goes, and obviously cross-platform gameplay is more or less required at this point. I also liked, it was interesting to see the Web3 bent of this project. I guess it is more like 2.5 in a way. It looks like they want to support real ownership of assets, likely for avatars. I assume it's blockchain related, but I don't really know. And I guess it's like a unique differentiator for them compared to other platforms. But yeah, it's curious. I've said for the past year or so, just looking at a bunch of other Web3 gaming projects and platform projects, that the ones that are going to be the most successful are the ones that lean into abundance and remove barriers to getting started, not those that praise scarcity and as a result have some sort of token gated barrier to entry. And so, when it comes to, competing with a Roblox or something, Soba doesn't really have a huge edge there, but competing against a lot of the actual Web3 projects that are trying to get into this space too, I think a lot of those are probably making a strategic blunder through, just asset gatekeeping. And Soba's going to be, more interesting from that lens, although it's too early to really have a strong opinion. But, the bigger takeaway to me is that I just think we're entering a golden era of UGC in games. The first era was about modding, and the second era, really started with Roblox, but clearly is going to be a lot bigger than that. Not all companies will make it, primarily because the battle for two-sided network effects, users and creators, it's just going to be super intense. But, there's more platforms building than ever. There's obviously Roblox, there's Manticore, there's Epic, and, which even owns some Manticore, and Epic's teaming up with Lego to build something. Metabot Unit 2 Games, as we just talked about. Playable Worlds is probably going to do some cool stuff. We're also seeing a ton of games lean into UGC, both with, next-gen modding platforms like mod.io that make it easier to integrate mods and reward creators, and even just making UGC a key mode of experiences, like we've seen with really big games like Genshin Impact and Free Fire lately. And all of that, in my opinion, signals much more unleashing of user capabilities in the future. And I'm genuinely excited to see what the next 3 to 5 years of UGC are going to look like, because right now when people say UGC in games, they really just think Roblox and everything is kind of small and secondary. But 5 years from now, I think it is true that there will be much more platforms in that discussion with large audiences and just more people than ever before getting rewarded in bigger ways than people think to create new types of content that people like. So who knows if Soba is going to be in that group? It's just way too early to tell. But in signaling a broader trend, it's super exciting.
I think I totally agree. And, you mentioned kind of the users versus the platforms. They're not always at odds. We talked about this with Craig Donato from Roblox, that they also help each other. It's kind of this dual flywheel effect where, and this is where their advantage of being around for 16 years, 17 years pays off, in that, they have a base of users who become creators. Those creators are now making more content. That new content attracts more users, blah, blah, and then it's a self-fulfilling cycle. And then you get these kind of dual flywheel effect. The content and the user bases grow in sync. You mentioned Manticore. It's a great example because, they have a fantastic platform. It looks really cool. It makes great stuff. No one uses it. I think they announced they have 3 million registered users, which probably means they have tens of thousands of active users at most. And so cool technology is cool technology. The question is, how do you scale this? And so I'm curious not only what does this look like? How easy is it to use? But how do they scale it when you're going against Roblox and Epic? Realistically, those are the 8,000-pound gorillas in the room right now. Or does this kind of just be a proof of concept tech, and then eventually somebody scrapes it up, just like you mentioned Facebook bought Unit 2. I thought that Manticore would be acquired by now, probably by Epic, but Epic seems to be figuring out with Fortnite Creative, so maybe not. But if they make this work and they can really do this on mobile with no code, someone will be interested in this, whether users find it organically and it grows organically, or it gets acquired. I think it's if they can make this work, it's
I think
interesting.
tuck-in acquisitions are definitely realistic for a bunch of companies in this space. I do think that scaling is going to be really hard. Just building network effects is super hard, but it's also just going to be very expensive competing on customer acquisition. And I guess like what comes to my mind a little bit, completely different industry, is just like ride sharing with Uber and Lyft. At its core, it wasn't a great business to begin with, just because you have to subsidize riders, and it was just sort of a race to the bottom that was backed by subsidies for the longest of time, not really letting the market compete. And I don't know if all of these companies are going to have great economics either for a long time, just because creators are going to want to get paid. But when you start thinking about all the other expenses at play, obviously the company building the platform is going to need to reinvest very heavily, very aggressively into building a competitive platform when it's super competitive out there in the market. But also, like, if you look at Roblox, which is, the most scaled of all of them today, the biggest issue is less even Roblox reinvesting and more just Apple. Those platforms taking their 30% fees. That'll like, greatly reduce the upside of your business model real fast when you have a player like that in the mix. And I don't see how, if someone wants to be cross-platform, especially on mobile, like, you're going to have to deal with that in some way or another. And that's tough. And also just other weird, rules, like, you can't really have games within games, or, there are weird approval issues. Is Roblox the exception to that rule? Who knows how all of that's going to shape up. But I think that it's going to be really challenging. And so not only are companies going to have to invest really aggressively to build out their technology and compete on user acquisition, which a lot of times in this case will just mean, again, creator subsidies to just try to get people creating more and more. They're going to be burning a ton of money to do this for what might not even be the best economics. So I think it's going to be awesome for users and maybe even some creators who can like get part of these subsidy programs. But I could see this business getting a lot worse before it actually gets better. And, you see like with a lot of businesses, you see unbundling and then rebundling again. And I think we're going to go through that cycle here where this is going to, like, UGC is going to unbundle. You're going to see it everywhere. And then eventually the best tools, once the subsidies wane out, are going to win in probably really big ways. But yeah, the path to get there is going to get wild, and I can't wait to see it.
I totally agree. And just, I'll wrap it up with some numbers. I mean, people criticize Roblox for not paying out enough to creators. That's why everyone wants to build a UGC platform that pays people better. I mean, they still pay 20 to 25% of their bookings total in cash out to developers every year. So it's not like they're paying nothing, but as you mentioned, they've got R&D to invest in. They got to invest in the platform. They got to pay Apple. They got to pay Google. Console fees are there on the console side, and on PC, they don't pay fees. It's just the payment processing. So, but they have said that if the platform fees come down from Apple and Google, that will all get paid straight to developers, basically. So, if you're a creator on Roblox, you're hoping that, the European governments, knock the guts out of Apple and Google and cut those fees globally. So that's more money in your pocket. And so with that, we'll wrap it up. Thanks, Aaron, for joining us and for subbing in. And again, as I mentioned, stay tuned for our episode next week with Tim O'Reilly. It should be super exciting.